Hey guys, welcome back. We wanted to put together a series for our mid-sized clients to walk you through the decision process to help you lower your expenses, find out where the waste is in your plan, and how to cut it out. So just a general overview on what's to come. We're going to walk you through fully insured, if you're still fully insured, some level funded solutions, and then also some self-funded solutions. And what are the different programs you can do at different levels? Now, one of the smartest things you can do is get your claims data if you don't have it. So we can do a claims retrieval program. We can actually retrieve your claims down to 25 employees if you're with Anthem or UHC, even if you're fully insured. And literally these two, and there's going to be more and more carriers where we can do this over time. But right now, Anthem or UHC, we can get full claims history going back 5 years. Then you know what you're dealing with. Then you know if you want to start going into the level funded or self-funded realm. So this is super key, right? And then we'll walk you through some issues that you can take advantage of in the secondary insurance market. Because the primary insurance carriers, for the most part, and I get it, rightfully so, overprice those low deductible plans because, if you have a $500 deductible and once your folks hit that deductible, they're going to use the heck out of that plan, so the carriers really want to keep that high deductible to not open a barn door to a lot of claims. So totally get that, but there's some plan designs we do, integrated secondary insurance that take advantage of different actuarial pricing models that the secondary insurance carriers have that the primary insurance carriers don't want to use. So we fit those together. We'll walk you through that, and we'll walk you through our claims auditing. Super important. This is basically you go line by line through your claims, anything really down to about $2,000. The only way, and I'm sure most of you out there are finance folks, CFO, CEO, when's the last time you've done a full reconciliation and not had to go down to the point where you're line by line to actually understand what's going on? So this is what we do. This is incredible. This is probably the biggest thing you can do. Here you need 75 employees minimum. But once you get to 75, this is the best thing I see out there because you're taking control of your own destiny, and then you know what to do from there. But we won't get into too much of that. Big pain point, RX, is pretty much everybody knows. A lot of stuff we can do, cost plus pricing, all the nonsense that just infuriates me with so-called rebates. Call it what it is, you're just reducing commission to 5 middlemen in the process. It's not a rebate from the drug manufacturer. It's lies, and we'll show that to you. And then there's some other different programs that we'll cover, but this is it. We'll walk you through this over 7 or 8 weeks here. I'll throw in some news as it comes out, just sort of fun stuff that we enjoy having a little bit of fun with but it does illustrate where you just get drilled in your plans, and if you're not careful, you're just going to waste money. So we don't want that. We want to educate you, keep you on point, and that's our jobs. We love doing it. Thanks. Bye. Hello, everyone. Welcome back. So let's go through the steps here, and starting 1, and we're going to end up at 7. So again, just the overview. So we just chatted about in step 1 how we want to score your current policy with HR, with the employees, with the cost. Get our renewal quotes if that's coming up for you, and see what we're starting with. This is one of my favorite parts to go with. We're going to hit this next week. We usually update these on Tuesdays and Fridays. So look to see a new email from us on Tuesday and Friday with new steps as we progress. And we start looking at our claims data. How do we get it? What do we start looking at? Do we want to even look at self-funded options? And again, we have self-funded options going down to 25 employees. And now once we do start going down the self-funded road, we'll look at reference-based pricing, just incredible stuff. One of the biggest areas you have to keep an eye on in terms of costs blowing up on you out of nowhere these days are prescriptions. This is where a lot of the risk is these days. I mean, it's progressing from 10, 15% of your plan spend to 20, 25% in a hurry. And then we're going to look at second opinion. Phenomenal stuff for employees, especially the employees that are unfortunately sick and employees that get sick with very serious illnesses where you could be in a life and death situation. This is a tremendous benefit to have. And it's actually a positive ROI, which is amazing. And then we're going to look at direct primary care. What is this? How does that help? What do we want to do? When do we want to use it? That sort of thing. So now we're going to look at your decision tree just to give you a little bit of a feel for that. And this is our process. It's very simple. This is what we walk through each and every time with you, and we love to get to put a visual in front of you so you know exactly what we're doing and you know exactly what's coming. And this is again, we kind of score the plan and get going, get our renewal quotes, see what we're working with, and then start pulling our claims. How do we do that? What are the different scenarios where we can get them, where we can't get data, that sort of thing. And then once we start looking at our data, how's our loss ratio over time? What does that look like? What's your employee age? It's sort of, and this is in one of the steps in here where we kind of dig into that a little bit more with an age grid. But for the most part, age is the biggest indicator of it, obviously of what kind of health spend. If you have a bunch of 20 something year olds, you're not going to have much health spend, right? So this isn't going to be as, impactful to your costs. If you have a bunch of 30-year-olds, make darn sure you got maternity on there, that type of thing. And 40, 50, 60, now, the wheels start loosening up on a car. So then we have to be more and more progressive and aggressive with the care we put in place to make sure that our employees are taken care of and we don't get hit with costs that we're not expecting. So and now what if we don't have a good loss history and we have an older population? Now there are things we can do to mitigate, especially against an older population that we'll get into over time. But we can still look at the secondary insurance plan regardless, just because of the tax advantages, and we'll stay fully insured. But now, if we do have good loss history, then we start looking in the realm of self funding, and we'll go back with RVP, reference based pricing and prescription. Make sure we get cost containment on there. And then, as we kind of wind our way back, we'll look at the tenure of your employees. Do you have older employees that have been with you 10, 15 years? Are they likely to stick around? Are you guys sort of in one geographical location? If so, you definitely want to look at stuff like direct primary care. It's a huge cost savings to the plan, so very positive ROI. In addition to, now we can also add in a second opinion program, so now your employees are so well taken care of, and we got to communicate that to them and get them using those plans, get them using these benefits, and you'll see it's a phenomenal thing, right? They use more and more of these benefits, and your ROI goes up more and more as they're more and more engaged. So that's what we love to do. That's our job, and that's it. So we'll get back to you again. Look out for your emails on Tuesday, Friday. We're gonna come through with next week on step one, or pardon me, step two, and then we'll start digging into the secondary insurance. And that's, as we're kind of going back through here, we will get you to this part. Start next time. Thanks a lot, and look forward to talking to you soon. Bye.